This has been a remarkable period for fixed income markets in particular. At one point in March, T-bond yields, which really set the standard for global bond yields, plunged to only a third of 1%, 31 basis points to be exact. This is the lowest level of bond yields we've had in 150 years of history. So that's a pretty considerable milestone. And it's unlikely, actually, that they're going to move that quickly to higher levels. Our valuation models would say, actually, the bond market is very expensive and that yields should rise somewhat over the months and years ahead. But we know that central banks will be keen to keep interest rates low right out the curve to engender a very strong economic recovery. And we also know from the lessons of 2008, 2009 that even after the economy gains traction, they want to be doubly sure, very cautious, and leave yields at maybe historic low levels for a longer period of time than would be otherwise the case. So I think we need to get used to a world where short rates and long bond yields will be in low single-digit area for a very, very long time. Credit markets responded to the COVID-19 crisis much more like stocks than like sovereign bonds, where bonds benefited not only from central bank buying, but from flight to safety. Credit markets responded initially to threats of default as businesses shut down. Now, of course, with the support programs that were put in place by March the 23rd, a very large rally, a sustained rally took hold. We entered 2020 with a degree of vulnerability in credit markets. Spreads were quite narrow. In the event, the spark came from COVID-19. Those spreads blew out, both as a result of rising interest rates on corporate bonds and falling interest rates on sovereign bonds. The net result of this is very attractive risk premiums now in the credit markets. We've actually been adding to positions as a result of that, rebuilding positions in credit that we had reduced heading into 2020.